Associates. John, thanks so much for joining me. What have you made of the Chinese stimulus just in general, and how much of a game changer it might be for an area of the market that's really struggled?
Yeah, good morning, Amber. Certainly, markets believed it was going to be a big game changer. I mean, when I looked at my screens first thing this morning, like, what a shocker. I mean, Hong Kong down almost 10% and Shanghai up almost 5%. It was just a timing difference. Obviously, the selling came in, after the fact when this new stimulus program maybe had less meat on the bones or less follow-up than some investors were expecting. Like, clearly, and this was, when it announced back on the 23rd of September, and it's given a huge lift to those markets since then, and a lot of cyclical stocks as well. But there's a lot of problems with the Chinese economy, and I guess investors once in a while they step back and think, well, maybe this is just not enough to turn around, the moribund housing market you've got there to get the consumer spending again, and it's hard to move a behemoth like that in terms of getting the growth back up to certainly nowhere near levels we saw it in the prior 2 decades.
I mean, we should also put it into context. Alibaba, for example, is up 40% just in the last couple of weeks alone. So the pressure in the pre-market doesn't really dent much of that rally. Have you been looking at these names, John? Have you been looking at ways to play that? Because I do sense a little bit of skepticism on whether or not these measures are going to work. So I wonder if you're there in this trade at all.
Not really, Amber. I've been doing this for a long time, and I've sort of avoided the Chinese stock market in a lot of ways, just with the accounting and other issues. Like, certainly you can play the China move economically on a global basis, but I don't really play a lot of those stocks directly because of changing regulations. And obviously, there's a lot of risk going forward in terms of trade flows and other things. More so from the U.S., but you see it in European markets as well, as they get sort of caught up more in the Chinese tidal wave than the rest of the global economy. So we stayed away from that. But like I said, it still can give a lift to global commodity to some degree. But this is not the China of the early 2000s or even the past decade. This is not a country that is just building capacity to expand. They're trying to get to consumer spending a little more, and in the process they're still producing a lot of cheap goods, and in effect they are exporting deflation to the rest of the world, and maybe that makes me a little bit more bullish on interest rates longer term. So,
in the sense of, you expect those rates to come down, because I think there's a bit of a debate on that after Friday's jobs numbers.
Yeah, people really get worked up about single numbers, and particularly employment numbers can be, vacillate up and down a lot. And yeah, you had the revisions higher for the prior couple of months, but yeah, the trend to me is still down. And you look at, Pepsi's commentary this morning, you look at freight numbers, you look at a lot of other leading indicators of what's going on in the economy. I still believe it's slowing down. Amber, I think what investors and have to do generally is you got to do a little bit of take the last 4 years out of the equation economically. It was an unheard of period of time in terms of stimulus and other things. I think this is not the trend going forward. I think we've used up a lot of what was needed to get the economy through the pandemic, including fiscal stimulus. Now, 7% of GDP? You run the savings rate in the U.S. from 7% down to 2.5%. I mean, the bullets are all out in terms of what you can do. So I think what we'll do is we'll migrate back towards what we saw in the prior 2 decades, which is slower global growth. The major economies of the world are mature. Look at Europe, look at North America. And if China's slowing down on top of that, which was the engine of growth from 2000 to 2020, you're going to have a slower growth global economy. Inflation comes down. So what does that mean? To me, that means we're not going back to zero interest rates, but we're going back to that lower trend. And then you can use that to sort of look at your investment strategy, how it impacts bonds, what part of the stock markets will do better as well.
Where do you put your money in that scenario in broad strokes?
Well, in that slow growth environment, I still think there's a trade left in the bond market. I mean, no one gets excited about the bonds, but I tell you, the 20 to 30 year long U.S. bond at 4.30 right now, to me, that's a bit of a gift with inflation heading to 2% and lower in a slower economy as I see it, even with higher real rates. So, I would be, adding there. But within the stock market, I'm a little more skeptical of the cyclical stocks. I'm not really building up positions in financials, metals to any degree. Energy is a bet onto itself just because the valuations are so cheap. The consumer is obviously struggling. I mean, Pepsi numbers tell you that. I mean, branding is going out and people are going down to some cheaper alternatives. That will continue, which will put pressure on margins. You've got to grow your way to prosperity. You can't cost cut your way to prosperity. So I think that's the risk. Now,
well,
the beneficiaries.
I want to pick up on that point because I think using Pepsi is a great example of that because, yeah, they're warning about sales, but guess what? Their profit forecast is unaffected. They still say they can grow the bottom line by 8% because they're going to do cost cutting. Do you think that will be an emerging theme? And will investors take comfort in that? Because we're also trading at pretty high multiples for the market, right? So you got to bet that the E is going to meet the P, right? The price.
Yeah, I would argue that completely, Amber. I mean, look at the move in the past year. I mean, you've got a 30% rise in the S&P 500, and you got earnings growth up less than 5%. This has been a valuation-driven market. Now, cost cutting as a formula going forward to grow your earnings. I mean, between cost cutting and financial engineering to some degree, that's been the growth story in the market for a lot of the past 2 decades. So yeah, it continues to some degree, but my point is you can only go so far with that. I think the stronger markets we saw for the past couple of years were a little more top line revenue driven, which is ultimately what I think you need, to improve, fiscal balances as well as, get growth, real growth in earnings. So there's only so far I think you can take cost cutting. But having said that, that again argues towards, what is the biggest source of cost cutting? That, argues back to the technology companies, which is still, I think you want to stick with those bets. You want to get the right horses in that. But, that will still be the greatest avenue to overall cost cutting is improving your productivity by probably increasing the use of technology.
Okay, and we're going to find